Hi everybody, hope you are doing well. I'm Nasir Ahmed Nofel and welcome to another bookkeeping video. In QuickBook, there are four categories of product and service. If you go to sales and from sales to product and services and click new, you can see there are four categories of either products or services. I have a video about these four items in which you can see how to add each and every one of them. But in today's video, I will be focusing on stock. A stock is such an item which you actually buy and then sell to your customer, and also want to keep track of your quantities. So I'll be doing a stock item in which I will be showing you how to actually record a purchase under a stock item and then sale of this stock item. And at the end of a particular month, we will reconcile with our Excel stock register. So first of all, we need to go to our Excel working where I have ready a dummy data to show how the stock works and how QuickBooks actually trace your quantity of a stock item. So the item I will be using, let's say I buy hard disks from a specific company and then sell it to my customers. So in 1st January 2022, I have a opening balance quantity of 100, and then in 15th of January, I'll be purchasing 150 at a rate of 1.90, and the opening stock has a rate of 2, which amounting to 200 for 100 of quantity of hard disks. Then in 25th of January, I'll be selling 50 hard disks, and the rate I will discuss the rate when I will be doing in this calculation or this treatment in QuickBook, and then I will sell 100 more items in 31st January. So first of all, click stock as I am creating a new stock item. Let's say inventory slash hard disks. Let me put a space between hard disk. Okay, if you want to give any item or service cost, you can go, and if you select or categorize it under a certain category, you can also create a new category and assign to it. And the initial quantity on hand, which means what is the inventory quantity you have in a particular point of time. So for me, this will be the 100, and the date will be 1st January of 2022. 1st January of 2022. Let me select the date from here. Okay, and the reorder point is the how many inventory will be in your hand when you can or you want to replenish another order. So let's say, for example purpose, it is 50, and now we have to do some accounting mapping here. What will be the stock asset? You can use a stock asset account, or you can create by clicking add new. Then the stock item will be inventory hard disk. If you want to give any sort of number, you can do so. Let's say 341, and click save and close. Then if you want to put a sales price, you can also put it here. And sales of product income, so I'm gonna assign it to the sales revenue. You can also price it with inclusive of VAT by clicking this and select the VAT rate here. Then you can, like sales, you can also put some information about cost here also. If you have a specific unit price of the hard disks, you can put it here, and you can also change it whenever you are purchasing from another vendor or any kind of any vendor in a different date. And the expense account will be, I am using a new one, so I am clicking add new. I want to see, name it CGS hard disk. Let's say 555 and click save and close. Okay, just by clicking save and close, I'm adding a new inventory. You can see there is a new inventory item of inventory hard disks, and the quantity in hand is 100, and the quantity for the lowest stock alert will be 50. And you can also, by clicking cognito or settings icon, choose whatever information you are required to see here. Next, I'm going to duplicate this tab, and from here I will go to report, custom report, and select balance sheet. The balance sheet actually run from 1st January of 2022 to 30th of June of 22. So if you go to the hard disk, you can see under the current asset there is a item name inventory hard disk, but with no value. So as we have inputted a opening balance, so we also need to have a value of this opening value, opening inventory there. So just from product and services, click edit and click starting value. The static value at a rate of 200, the value will be 200. So from here, as of date of 1st January of 2022, we have initial quantity on hand is 100, and the initial cost, or which is the rate actually, is 2. So you can see the value here, and if you want to referencing it by a specific name or code, you can do so. And the adjustment I will be using is the retained earnings, not opening balance equity here. And click save and close. So now let's get back to the balance sheet. You can see under the inventory now we have a value of 200. And if you go to chart of account and search retained earnings and just click run report, and run the report from a specific period, in my case it is from 1st January of 2020 to 31st January of 2022, you can see there is a value of 200, which actually came from by adjusting the value of the inventory from product and service. Now I will do the next part, which is purchasing a 150 quantities of hard disks at a rate of 1.90. So from expense, click bill, click add bill, create a bill. First, select a supplier. Let's say Lister, and that it is 15th January of 2022. 15th January of 2022, and Terms are 15 days. Let's say bill number is 111. As I am actually purchasing a product or service, so the item I need to actually uh, input this. The my item is inventory hard disks. The quantity is 150 at a rate of 1.90. Amount is, let's say, for make it or keep it easy, I am selecting no VAT. So click save and close. If I reload it, reload the page, product and service page, you can see there are 250 in my hand, which is this. So this is the actually balance quantity, and this is the balance of amount. And if I go to balance sheet, and you can see there is a inventory value of 485, which is by combining these two amount. One is from opening inventory and one is from purchasing 150 units of hard disks. Now I'll be selling the items. Now let's create invoice. The date is 25th of January. Let's say the product and items will be inventory hard disks 50 at a rate of 3. This rate actually the QuickBook uses FIFO basis, fast out basis for inventory valuation, which means whenever you are selling, uh, for example, I am selling 50 quantity of hard disks here. So the for the serious purpose or for the inventory valuation purpose, the QuickBook will use the rate of 2 here. Uh, so and this I am selling this item for $3 each, £3 each rather. And again, to keep it easy, I am selecting no VAT. Click save and close. I'm gonna duplicate it to show you the impact of selling these 50 quantities of hard disks. Just change the date. Let's say this is the actually I am going to report actually, not sales. So from report, I am going to balance sheet. Click the balance sheet. Now there is a reduction of our inventory in hand. If you see my calculation, after purchasing 150 units of inventory, we have a balance in amount which is 485, and after selling 15 units of inventory at a rate of 3, but for this inventory valuation purpose the rate will be 2, because as per IS2 inventory is actually valued at lower of cost and the resale value. So cost is the lower side here, which is $2. So the balance amount is 385. And if I go to the profit for the period, so you can go to cost of sales. Under you can see there is a series for hard disk which is 100. As I told you, the inventory valuation method QuickBook uses is FIFO basis, which means for the 50 unit of inventory sold, the QuickBook uses the opening balance rate, which is 2, and the COGS will be for $50. 50 quantities of hard disks is 50 into 2, which is 100. Next, for the last two transactions, again I'm creating invoices. Now let's say this one, the date is 31st January. Product and item will be inventory articles, and the quantity is 100. The reason I have separated 100 into 50 250 quantities, because as QuickBook uses FIFO basis inventory valuation, if you see that we have initially 100 quantities of inventory at a rate of 2, and we sold actually 50 of them. So that means out of these 100, we have only 50 quantities remaining from the opening balance. So that's why the first 50 will be valued at $2, and the last 50 will be valued from this purchase, which is 1.90. This is the FIFO method of valuation. That means first in, first out. Whichever comes first, you can all need to sell it first. So the inventory quantity is 100, and which is at a rate of 3.5 selling price actually, and no VAT, and click save and close. Now go to the balance sheet to see inventory impact on it. You can see the inventory valuation 190, as this is the case in my this is also the case in my working, because the from 385 first 50 is valued at a rate of 2, which gives us closing stock value of 285. Then our next 50 has a value of, if I multiply, which is 95. Okay, so from this value, if I deduct 95, we have this value. So this is the actually FIFO method of inventory valuation, and the QuickBook actually shows that the QuickBook uses FIFO valuation method. And if I go to profit and loss, let's say, okay, let's check the COGS. The COGS is 295. If you aggregate these three value, as we have sold 150 units of hard disks, you can see the sum is 295, which is the COGS value, and this is the COGS value. So you can see the impact of selling your inventory item or purchasing inventory item in the balance sheet and also in income statement. And one more thing, let's say, just reload it to see the quantity in hand. If you scroll through the inventory hard disks, you can see there is quantity of 100. From our working, you can see that the closing value of closing stock quantity is also 100. Let's say after physical counting, you have 90 actually in hand, which is physically existed. So to adjust this, just click the drop down and click adjust quantity, and the quantity in hand is 90. The quantity, this is actually the recorded quantity, and this is the actually physical quantity you have. Now you can choose stock shrinkage account to adjust your quantity or the COGS hard disks. I am using COGS hard disks, and click save and close. Now go to balance sheet to see the impact. You can see the inventory balance actually reduced from 190 to 171, if you see. So How is the 171 amount is actually calculated? So just if I find out the difference of our closing balance before this physical adjustment, quantity adjustment is made, you can see there is a one $19 difference, and the reduction of quantity is actually minus 10. So the valuation is again 1.9, as we have actually used up the 100 unit, which is actually valued at $2 or 2 GBP per unit is used up by selling these two. And then we also used 50 of out of 150. So the rest 10 adjustment, which is actually the shrinkage of inventory or loss of inventory, whichever the cause is actually valued at a rate of 1.90. And this will also increase your CGS, as I have to use a CGS account to actually uh, adjust my uh, absence or theft of physical inventory. And this calculation is also for 10 1.9, which will give me $19 in negative form. You can see the sum is 314. If you go to income statement, you can see that the CGS value is for hard disks is 314. This way you can actually track inventory in your QuickBook. I hope it is simple and easily understandable to you. So, and if you have any kind of queries regarding this videos, or if you want to any know anything about accounting or bookkeeping, just comment in our comment section, and follow our channel for more videos, and subscribe. And also follow our Facebook and LinkedIn pages, and also visit our website. And if you want any kind of accounting or bookkeeping service, you can go to this website. This is our website. And scroll down and scroll around to see what we are, and what kind of service we are offering, and what people are consist of in our team, and their qualifications as well. So I will put the link in the description box.